Welcome back to Money with Jacob every Tuesday and Thursday at 5 p.m. Eastern Time. And this is where you send me your money questions and I will answer them as if they were my own. And look, I am not a financial advisor. This is not financial advice. In fact, I have no financial license of any kind. I simply have a philosophy that has got me to where I am today, 28 years old, over $700,000 in a stock portfolio, and 100% debt free. So if you got any money questions, you just want some simple philosophy applied to them, aka my opinion, then be sure to send them to me at jacobbuildswealth@gmail.com or drop me your questions in the comments section below. I'll take them anywhere I can get them. So let's kick it off. Today we got 3 questions as usual. And we're starting off with Balaj. Balaj writes, "Hey Jacob, I've been watching your channel and really appreciate how clearly you explain financial topics. It's been super helpful. I'm an engineer working in sales and my partner and I save about 6,200 euros a month that we're ready to start investing. We're thinking about investing into 4,000 a month into XLK, Information Technology ETF, 200 euros a month into NVDA, and 2,000 euros a month into Bitcoin. I know it's a bit aggressive, but I'm aiming for a high long-term growth. Do you think this mix makes sense, or would it be smarter to just put it all into XLK, Information Technology ETF instead?" Balaj. Balaj, 6,200 euros a month. As an engineer, you and your partner are crushing it. That's like $74,000 a year. If my math is correct, which it is. $74,000 or euros a year. Actually, let's stop saying euros. I'm going to start using dollars because I'm just accustomed to dollars. So please forgive me. But $74,000 a year into investments. You have so much potential in front of you to build a lifetime of wealth, and I don't want to see you screw it up. So I want to pull up some data here of cumulative returns since 2015. We have a yellow line of NVIDIA that is up 25,600% over the past 10 years. We have a green line of Bitcoin that is up 22,691% over the past 10 years. Then down way below it is the XLK Information Technology ETF up 572%. And below that is the orange line, which is the S&P 500 up 223% over the past 10 years. Now you didn't even mention the S&P 500. All you mentioned were XLK, Bitcoin, and NVIDIA. And I totally get why you're wanting to put your money into NVIDIA and Bitcoin. 22,000, 25,000% gains. We all want that. But I'm going to call it for what it is. It sounds like you want to get rich more than you actually want to get rich quick. Actually, it sounds like you want to get rich quick more than you're actually focused on long-term wealth building. And you're already doubting yourself. I think you know it's true too, and that's why you're asking me, should you just instead put all of this money into XLK? Now, Balaj, you and I come from a very similar background. You're an engineer, you're in sales. I've been selling software in sales also for the past 5 years. And I want to show you that I have no Bitcoin, no NVIDIA, no individual stocks or anything in my portfolio. I only own ETFs, and that's because I believe in getting rich slowly, and I also believe that your income is your greatest wealth building tool. NVIDIA nor Bitcoin is going to be giving you $74,000 or euros a year like your income is. So I want to show you my portfolio. From 2021, January 1st of 2021 to now October 19th, 2025, I have contributed $474,000 into my portfolio. That's about $94,000 a year, and you're looking at contributing about $74,000 a year. So we're pretty close in what we're able to contribute. I have gained in investment change $257,900. So I've gotten about 50% return on my portfolio over the past 5 years. No, that is not 22,000% like Bitcoin or NVIDIA, but it's all right. But I'm not worried about this instant gratification, get rich quick. And this is where I believe wealth building really takes control whenever you invest into broad market indexes. If I never invest again, I just put my $738,000 into the stock market where it's already there. I never invest another dollar again. I'm about to turn 29, so in 31 years, I'll be 60 years old. The stock market does 10% a year on average since 1950. If I just leave that money there for the rest of my life, my portfolio is going to be at $14.1 million by the time I'm 60 years old. This is real wealth building. I don't need NVIDIA and I don't need Bitcoin to get there because I'm looking to build wealth slowly over time, and it's going to be a good, fun ride. Like, I look at this right now, year zero, here I am, 28, 29 years old. I'm at that $738,000. But just in year 4, when I'm 32, I'll be at $1 million. In year 10 here, whenever I'm 39, I'll be crossing into $2 million. In year 20, whenever I'm 49, I'm going to be touching $5 million. So this is slowly building wealth, but then it just takes off. And this is where I want your portfolio to be also. I want this to be slow, steady growth, something that you can just buy and never think about it again. This is why I love ETFs. So let's go back to these cumulative returns since 2015. The way I think about investing is I want to put my money into the least risky asset as possible, and then I just focus on building wealth through my income, going to work every day, getting my paycheck, investing, and I never have to think about these investments again. You can't do that with Bitcoin. You can't do that with NVIDIA. And with the XLK Information Technology ETF, I actually think that's a really good ETF, but we don't want to base our entire portfolio on it. So right now you're thinking from bottoms down. You're thinking first about the giant gains at the top. You're saying to yourself, what can I invest all my money into and get the most for my return? And you're thinking about risk second. I think about risk first. I want to prevent losing money, and then I think about the gains. So I think from bottom up. I think first the S&P 500, then I think about information technology ETFs like XLK, and then I think about potentially in the future, after I already have wealth built, about adding in cryptocurrencies or individual stocks. So I want you to think first, what is the most amount of money you can get in the least risky asset you can get? And that would just be putting all of your money into the S&P 500 and specifically State Street's SPY. You mentioned XLK, that's by State Street. So let's talk about State Street's SPY, S&P 500 ETF. Let's say you just put 100% of all of your money there. Right now, we're looking at your cash flow. You would have $6,200 a month. That's where you're at right now. And this would be like a conservative portfolio. Let's say you invest 100% of your $6,200 into SPY. 5 years, 10% is what the market averages. In 5 years, you will have $464,000. That would be gains of $86,000 and contributions, what you put in at $378,000. So it grows slowly. But listen to this. If you leave that $464,000 there for the rest of your life, or let's say the next 25 years, I'm going to pretend you're 30 years old here because you didn't mention your age, but let's just pretend you're 30. If you leave it in there for the next 25 years, from 35 to 60, at 10% a year, you will have $5 million. Those are gains of $4.6 million, and all you had to do is contribute $378,000 right now. This is where I say I want you to build a base of a good diversified portfolio. Make that the base, because I know right now you sound super excited about technology, you sound excited about Bitcoin, NVIDIA, information technology ETFs, but the times change. You know, sometimes the number one market dominant industry could be energy, or it could be consumer staples, or it could be financials. We don't know when it's going to change. Right now, it just happens to be technology, and we need to be aware that it can change anytime. So we want our base, our foundation to be the S&P 500. We get diversification across 500 companies, 11 different industries. Now, I also do believe that this is the most conservative portfolio, 100% S&P 500 for a young person. I do think that's the most conservative we can be. There are people out there buying Bitcoin. There are people out there buying individual stocks or focusing 100% into technology ETFs, and that is a lot more aggressive. And I too want to be more aggressive, and I will tell you that in my own portfolio, I am more aggressive than just 100% S&P 500. So how can we be more aggressive? Well, this is where I like to look at building upon that foundation of the S&P 500 and then adding in an information technology ETF. So what I like is a 60% portfolio based on the S&P 500 and then a 40% portfolio on XLK, the information technology ETF that you like. And I want to show you just XLK's long-term performance here. Whenever we look at XLK since it was launched in 1998, it's only up 9.91%. That's the cumulative annual growth rate. The S&P has done better than that. Of course, this was launched at an interesting time being the dot-com bubble. If we look at it going back on the past 10 years, it's up 23%. That's what it's been averaging. Pretty freaking good. And since 1998, 9.9%. So let's just kind of meet in the middle and say that the XLK averages 15% a year. So let's build you out an aggressive portfolio, 60% S&P 500, 40% XLK. That would put you at Jacob's aggressive portfolio, cash flow $6,200 a month, $3,700 of it would be invested into SPY, the S&P 500 ETF, that's 60%. $2,500 a month would be invested into XLK, Information Technology ETF, 40%. In 5 years, we'll say that this portfolio would compound out to 12%. You would have 14% in 15% in XLK, 40% of your portfolio there. You would have 10% from S&P 500, 60% of your portfolio there. That gives you a compound annual growth rate of 12% for the next 5 years. In 5 years from now, you would have $483,000. That would give you gains of $105,000. That's what the market returns to you. And your total contributions, again, would be $378,000. It's not a whole lot more in the short term, but in the long term, it can be a lot more. And in 25 years, when you're 60, if you don't add another dollar to this again, you just contribute $378,000. You let this ride for 25 years. You average 12% a year. At the age of 60, you will have $8.2 million. That would give you gains of $7.8 million. All you had to do is contribute $378,000. This to me is building long-term wealth at a really good growth rate. I don't need NVIDIA to do it. I don't need Bitcoin to do it. All you need to do is go to work, continue earning really good income, investing it into the ETFs. I like the 60% S&P 500, 40% information technology. That's what I'm into. It sounds like you're more aggressive too. That could be a good one for you. And you're going to be so rich, Balaj. Now, I will say that just get the foundation in there. You can add Bitcoin and individual stocks into your portfolio, but just for the next 5 years, I think you should challenge yourself to get that first $483,000 invested, create that foundation, and then once you have that there, that's kind of like your nest egg. Just let that grow for years and years and years and years. And then after you get to that foundation of that $483,000, that's whenever you can start saying to yourself, I want to buy individual stocks like NVIDIA. I want to buy cryptocurrencies like Bitcoin. You can be more risky with your money, but whenever you're younger, you have less money. Therefore, you don't have as much, you can't risk your money. If you don't have money, you can't risk it. You need to build wealth first before you risk your money. It doesn't work the other way around. If you start risking your money before you build wealth, you're building wealth backwards and you're never going to build wealth. So this is what I would do, Balaj. I would either do the 100% S&P 500 or I would do the 60-40 split that I mentioned. Up to you though. All right, going on to question number 2 coming from Derek. Derek says, hi Jacob, I'm 35, married with 2 kids under 2 years old. I own 2 properties, a condo with a 3.3% mortgage. I owe $95,000 on it. There's HOA fees of $330, and it nets $611 a month after expenses. I own a 2-family home where I live in 1 unit and rent the other unit for $1,900 a month. The mortgage is $3,567 at 6.6%. I have $120,000 I could use to potentially pay off the condo, $90,000 in my 401k, and $75,000 in liquid investments. My monthly expenses are about $1,891, and I'm saving roughly $3,300 a month. I'm thinking about paying off the condo this year to reduce my debt to income ratio, then use the freed up cash flow to save for a single family home for my family by 2029. By then, I'd rent out both units of the two-family property. I'm torn between paying off the condo now versus keeping the cash for future flexibility and a down payment. I just don't know if I want to have 3 mortgages by 2029. What do you think? Derek, what I think is you do know you don't want to have 3 mortgages by 2029. That sounds awful. That sounds like a terrible idea. Brother, you are killing it though. 35 years old. You got 2 kids already. You're married. You're a family man. You're building wealth. You're investing your money. You got a 401k. You got a job. You are a picture perfect husband. Your kids are going to be so proud of you, man. You're doing awesome. This is great. But first thought is, your money's everywhere. Like, it took me a long time to dissect all this, so I want to condense it down into one spot. So I made up a chart here. It says, Derek, we got your assets listed. We got your condo, cash flow of $600. We got your mortgage on that, which is $700 a month, and you owe a total of $95,000. We then have your own home, your rental unit, which is a mortgage of $3,500 a month. You have your renters paying you that cash flow of $1,900 a month. And then your rent that you're paying to make up for the rest of this mortgage is $1,600 a month. Your total cash flow, including your condo here at the top, is $3,300 a month. You have cash in the bank, $120,000 that you're thinking about using to pay off your condo. You have investments, liquid investments of $75,000 and a 401k of $90,000. Okay, this is a lot more condensed. I can work with this a lot better here. It looks more clean, more simple. Now, Derek, I'm going to tell you, I don't believe in debt. The only debt I believe in is a 15-year fixed mortgage for your primary residence. I don't believe in taking out debt to buy rental units or properties, anything like that. I wouldn't take out money to buy stocks. And I don't think you would take out a loan either to go buy stocks. So I don't think it makes sense to take out a loan to buy a house. These are investments. These aren't our properties we're living in. These are investments. And I believe in first doing hard work and earning money and then using that money to invest, not borrowing money, investing it, and then going and doing the hard work afterwards. I'm a hard work guy first and then investing, not a borrow money guy ever. So my idea is we're going to pay off all of these units and then we will only have a 15-year fixed mortgage by the time you want to get your house in 2029. It doesn't sound like you're in a huge hurry. Your kids are only 2 years old. So you're maybe in a little bit of a tight spot right now and you're not dying to get in there. So we got time, man, but we're going to get all of these units paid off, not just one. So this is what I would do. Looking at Jacob's plan, we see assets. We got your condo. It is going to be paid off. Let's pay down that $95,000. That would turn that cash flow that you have right now into $1,300 a month. That's $15,600 a year. Nice work. All right, now we got your home and your rental. This would be your mortgage of $3,500 a month. You got that cash flow coming in from your renters, $1,900 a month, and then your own rent, which is $1,600 a month, and that makes up your entire mortgage. Now that we paid off your condo, you're gonna have just all that cash flow going to you. So that's $4,000 a month in cash flow. We paid off that $95,000 in the condo, and so your cash went from $120,000 down to $25,000. That's good. Your investments are at $75,000, and you still got this 401k at $90,000. Here's what I'm thinking, and here's where you may not agree with me, Derek, but we're going to try to get all of this paid off. Over the next 3 years, by 2029, that will make up 2026, 2027, 2028. 2029 comes in 3 years. Your kids are going to be 5 years old. I say what we do is you're going to have this cash flow of $4,000 a month. That is $48,000 a year, $144,000 over the next 3 years. You also have current investments of $75,000 a year right now. Or not a year, you have investments of $75,000. I'm going to drop all of that down to zero. And what we're going to do is over the next 3 years, we're going to put in $75,000. Right now, we're going to pay down on your home/rental unit that you're living in right now. We're also going to put in $144,000, this cash flow that you have over the next 3 years, into your home or rental unit that you're living in right now. That will enable us to pay down $219,000. I don't know how much you have left on this home/rental unit that you're in, but $219,000 should be a good part of this payment gone away. Now you're already getting cash flow of $1,900 from this rental unit. Imagine whenever you get moved out of here, you're going to rent the other half of it for $1,900. So you're going to get $3,800 from there. Once you get the condo paid off, once you get this rental unit paid off, you're looking at cash flow of $7,800 a month. That's condo, $1,300. Your unit is giving you $3,800, and it sounds like your work that you're doing, your job, is giving you an extra $2,700. You're bringing in almost $8,000 a month with all these rental properties and your work. You'll then have cash of $25,000, and you'll still have that 401k of $90,000. I think that's great. The cash is your emergency fund for the next 3 years. We can put that investments into the house, and then we can pay all of this down over the next 3 years. And then in 2029, if you can have your rental unit completely paid off, the home/rental unit and your condo completely paid off, that's whenever I would go take out a 15-year fixed mortgage and get my family home. I mean, it's going to give you 2 properties and a family home. If you want to get moved into the house sooner, you got to give up one of these properties. We're not going to have 2 mortgages. And that's because I don't want 2 mortgages for the same reason you don't want 3 mortgages. Anytime you're over leveraged, it just takes one thing to go wrong until you can destroy yourself. You can get bad tenants that destroy your property. That can really set you back. You can maybe not rent out your properties at all. Maybe, unfortunately, you go through a crazy drought in your area, nobody rents your properties, your payments come either way. Maybe you lose your own job, maybe something happens to your wife, God forbid something happens to your kids, and you're set back financially and you have all this leverage on top of you. This is why I don't believe in using money to go buy a house, any type of rental unit. So we're going to get all of these paid off. If you want to get into your house sooner, and you don't have one of these units paid off, if you don't have your rental unit paid off where you're living right now, then sell your condo and pay it off. If you don't want to do that, then sell your current house or rental unit, keep your condo, and then go get out a 15-year fixed mortgage to get into your family home. But my plan is we're going to get both the condo paid off and the rental house paid off before you get into your primary residence. That's the way I would do it. Totally up to you though, Derek. Sounds like you haven't had a problem taking out a couple mortgages already, but I hate debt, brother. I hate it so much. All right, last question coming from Eric. Eric says, what do you think about investing into semiconductor ETFs? Specifically, I'm looking at SOXQ semiconductor ETF. Eric, what do I think about semiconductor ETFs? I think these things go hard. I mean, they go hard, man. Pulling up a chart right now of 3 semiconductor ETFs. There's 3 big ones out there. There's SOXX, there is SMH, and there is SOXQ. These things go up and to the right. I mean, they go hard. It is no shocker at all that these things are gaining tons and tons and tons and tons in percentages. Just like Balaj is asking about buying NVDA, which is a semiconductor company. They have been outperforming for the past decade. They're doing really well. Now, specifically the one you're asking about, SOXQ, it didn't launch until 2021. It has at least a lesser track record. It hasn't been out for as long. And in 2021, I mean, it's up 110% over the past 4 years. It had a nasty 45% drawdown in 2022, but I mean, over the past 4 years, it's averaging 25% a year. Pretty dang good. Now, I want to show that SOXQ and SMH and SOXX, all of these semiconductor ETFs are pretty much the same thing. I think you can choose any one of them and they're all going to perform about the same. So if we look at the top percent in assets, the top, like how much money is in the top 10 assets and all these are 100% semiconductor ETFs. They are very concentrated pure plays. 60% are in the top 10 names in SOXQ. These are all the NVIDIAs, Broadcoms, AMDs, Micron, Intel, Taiwan Semi. 72% of assets are in the top 10 names for SMH, and 56% of assets are in the top 10 names for SOXX. Pretty much all these semiconductor ETFs are all concentrated into those same names. So they're all pretty much going to give you the same thing. But I want to point out though that when I'm trying to research these, I like looking at 10-year periods and 10-year investment data to try to get a better picture, not just seeing like how has it been performing for the past 1 or 2 years, but how has it been performing for the past 10 years? Because in a 10-year cycle, we can get a picture of a full business cycle, not just, recent biasism, which is 1 or 2 years. Obviously, over the past 2 years, semiconductors have been crushing it, but what about 10 years ago? So this is where I start looking at SOXQ compared to SMH and SOXX. Over the past 3 years, SOXQ is up 41%. Pretty good. It has been averaging 18.4% since it launched in 2021. But whenever we start taking a look at the other ones like SMH is up over the past 10 years, 30%. I mean, this is what they're averaging. It's averaging 30% a year. SOXX is up 27%. That's what it's averaging, 27% a year. It's interesting though, like with SOXX, this iShares semiconductor ETF, it launched in 2001 whenever the dot-com bubble was going down. And since then, it's actually only been averaging 11.88% a year. So I want to keep comparing the SOXX ETF compared to the S&P 500 or SPY, because there's more data to work with. I think all of these ETFs are pretty similar, the semiconductor one. So I want to compare it to the S&P 500 because that's the benchmark, the baseline that we're comparing this to. Because S&P 500 is like, there's not a lot of risk. So we want to see how much more reward is there investing into a riskier asset like semiconductor ETF. And here, again, we can see that over the past 10 years, the SOXX ETF, semiconductor ETF, has been averaging 27% a year, while the S&P 500 has been averaging 15.2% a year. I mean, that's almost doubling it. So, I mean, that's good. Now, why doesn't everybody buy these semiconductor ETFs if they're doubling the performance of the S&P 500? And that's because a lot of people that are buying these semiconductor ETFs aren't thinking about them with investment mindsets. They're thinking about them with trading mindsets. And if you try to trade any individual stocks, or if you're trying to trade ETFs, anything at all, you're more likely to lose money. But it's especially true in these really volatile semiconductor ETFs. So I want to show you something. Looking at the SOXX ETF going back to 2001, there have been 13 times this ETF has dropped by more than 20%. It has dropped from 2001 to now 6 times by 20%. It has dropped 3 times by 30% or more. It has dropped twice by 40% or more. And has dropped twice by 60% or more. That means if you put your money into the SOXX semiconductor ETF and then it drops 60%, you put $10,000 in there, $60,000 or $6,000 of it just went away. Now your portfolio is at $4,000. If you don't sell, you don't lose your money. But a lot of people aren't using this as a long-term investment vehicle. They're just thinking, how can I get rich quick? How can I make money now? And whenever they watch their portfolio go down by 60%, they get scared, they sell, and then they never get that money back. And that's where I think that these semiconductor ETFs are dangerous. I do think that semiconductors are a very important part of our society and part of our stock market and part of our progression. It's important technology. And it isn't just because of AI. They've been around since about the 1940s, and they're in everything now. They're in televisions, they're in cell phones, they're in washing machines, they're everywhere. And I don't see a world in which 10 or 20 years from now, semiconductors are going to be less important. They're probably going to be more important. So I do think these semiconductor ETFs are good investments, but we have to be thinking about them for the long term because they are going to drop. Basically, we've had 13 drawdowns since 2001 to now. That means that these things are drawing down by more than 20%. They're dropping by more than 20% every 2 years. That's a lot of volatility. Many investors can't stomach that type of volatility. If you're thinking about this in the long term and not the short term, it's okay. So I want to also compare the volatility in semiconductor ETFs to the S&P 500. So pulling up another chart here I put together, we can see the total number of drawdowns since 2001 in SOXX semiconductor ETF compared to the S&P 500. There have been 7 drawdowns of 20% or more in the S&P 500 from 2001 to now, while there have been 13, almost twice as much in the semiconductor ETFs. The S&P has seen 4 drawdowns of 20% or more. It has seen 1 drawdown of 30% or more, and has seen 2 drawdowns of 50% or more, that being the dot-com bubble and then also the GFC in 2008. So there is just a lot more volatility in semiconductor ETFs. I think that they could be a good part of anyone's portfolio if they're willing to accept the fact that these things go up a lot and they go down a lot more than the S&P 500. We just have to remember, this is a long-term investing. This isn't trading. This is a long-term investing. And I think that we need to create our base portfolio, kind of like what I was saying to Balazs. We need to have our base portfolio first of the S&P 500. Once we have that base portfolio, that's what we would call in the investment world or the finance world, our core portfolio. Once we have our core portfolio based around the S&P 500, then we can start adding little individual investments like concentrated risk into semiconductors, or maybe a little bit of Bitcoin, or maybe a little bit of NVDA or individual stocks. But we first need that base or that core portfolio of the S&P 500, maybe a little bit of an information technology ETF like the XLK that we talked about. But once we have wealth built, that's whenever I think that we can start adding in these semiconductor ETFs. They are good additions to portfolios, but they need to come after wealth has already been built in the portfolio. And they also have to be bought with the mindset that this is long-term investing here. This isn't trading. We're thinking 5-10 years down the road, not 5 or 10 minutes down the road. So that is my answer, Eric. I think they're good, just at the right place and the right time. So that was Money with Jacob every Tuesday and Thursday at 5 p.m. Eastern Time. Be sure to send me your questions right here at jacobbuildswealth@gmail.com. I will be sure to answer them, and I will see you Thursday.